Okay, we are live. Thank you everyone for bearing with me as I got everything sorted so that we could be live on Facebook because it is a really important session with the deadline looming for RRSP contributions. And as I said, today we're going to be talking about the different forms of registered versus unregistered investments. There's a lot of acronyms up on the stage between RESPs, RDSPs, FHSAs, RRSPs, and TFSAs. I'll be talking through each, explaining what they are, sort of the pros and cons of each, and helping you to make an informed decision of what's the best tax strategy for you. But before we go into this, I want to talk a little bit about what is tax planning, talk a little bit about salary versus dividend, which is an important question that we do get over and over again when it comes to tax planning, and a little bit about income splitting before we jump right into these different forms of investing. So many of you know me. My name is Andrew Wall. I'm the managing partner here at CPA4IT. And our mission at CPA4IT is to help our clients organize their finances, create wealth, and transform wealth into a legacy. We've been specializing in independent contractors since 1984, and we specifically serve owner-managed service-based businesses. So a lot of the tax strategies that we're going to be talking about today are specific to that demographic of client. And hopefully you'll find this information useful. And if you do, please comment and share. Of course, those of you who are in the Zoom meeting with me today can ask your questions through the Q&A. And I will be going through an order of Q&A and then looking at chat. And of course, if anyone raises their hand and actually wants to speak, I'll allow you to speak as well. For those of you who are dialing in through the joys of social media and you're watching this live in one of our live streams, you can comment on the video and we will have one of my colleagues will relay that content over to us live here in our Zoom webinar, and we'll do our best to answer your questions. And if we don't get to them today, we will be sure to come back and answer them online. So why do contractors ultimately choose us? Obviously we help our clients organize their finances, create wealth, and transform wealth into a legacy. But a lot of people first come to us for that free initial consultation where you can get a little bit of understanding as to whether we're the right fit for you. We do offer a turnkey solution, and by that what I mean is we have an in-house paralegal firm, so we can help you with the incorporation and setup of your business along with the bookkeeping and the accounting, so full life cycle. And then some of the proprietary things that we do for our clients include our benchmarking analysis, which shows you how you compare to the average and the median in our database, identifying risks where you're maybe above the average and potentially red flagged by CRA, as well as opportunities where you might be below the average, and there may be some additional opportunities for maximizing those deductions. And then our audit representation protection. And if you're on one of our prepayment plans, that means you're getting that audit representation protection included for free. And this means that if you're ever audited by the CRA for any of the work that we prepared under that audit protection, we will represent you up until the third and final stages of appeals without charging you for any of that work. And as we know, audits can be scary and overwhelming. And the last thing you want to be worried about is what the cost is going to be. You want to make sure that you're getting all the help and support you can to make sure that you can fight CRA's challenges. So let's talk a little bit about what tax planning is, because a lot of when we talk about RRSPs and TFSAs, we're looking at that from a tax planning perspective. I was watching a video on Global News today about who's made contributions, who hasn't, and why they do it. And some people do it for retirement, but a lot of people ultimately do it from a tax planning perspective, which is looking at how they can use RRSPs to lower their effective tax on their personal tax return. So tax planning is the analysis of financial situation or plan from a tax perspective, and the purpose of which is to ensure tax efficiency and a reduction of tax liability and maximize the ability to contribute to retirement plans are crucial to that plan. Now, one of the things when we talk about tax planning is looking at the various personal tax brackets. And it looks like I've accidentally pulled the 2021 slide instead of the 2022, so I apologize. These are very close to what they were in 2022, but slightly different. We do have slight growth in these tax brackets. But when we look at these various different tax brackets, you can see there's a whole bunch of them. And this is because we have combined federal and provincial. And this is specifically looking at Ontario here. And the reason I bring this up is because where RRSPs can come into play is how we can use them to bring you down to a lower tax bracket. Now, with a marginal tax system, your only tax on the new rate on the income in that new bracket. The income below that bracket always stays taxed at the lower tax rate. So which is why you'll hear the difference, marginal tax rate versus effective tax rate. So effective tax rate is taking your total tax and dividing it by your total income. That gets you your effective tax rate. Your marginal tax rate is the tax that you pay on the last dollar of income. So if you're over 1,000, it would be 53.53% back in 2021, and the same amount but slightly higher for 2022. Although I actually think I did update these. It just didn't update that one number where it says 2021 marginal tax rates. I'm gonna fix that. Hate these little slip ups. So these are indeed the rates for 2022. And so that's where tax planning, as far as using things like RRSPs, using income splitting, or tax deferral strategies that you have inside the corporation, can be tools to help you avoid peaks and valleys. Because if you have peaks and valleys, let's say that you had 1 year of $250,000 of income and 1 year of $150,000 of income personally, where you'd have a better tax, or you pay lower taxes overall if you actually could merge those and get $200,000 in each year instead of 150 and 250. And that's because that would bring that year that's above 221,000 and bring that income down into lower tax brackets. That can also be done by splitting amongst different family members as well. And that's why we want to look at how we can optimize the tax planning using a number of different strategies, including dividends, smoothing income between years, income splitting between different family members where it is possible. Now, TFSA, or tax on split income, has taken away some of our income splitting strategies, at least through the use of dividends, primarily with children and spouses under the, when you are under the age of 65. Although there are still dividend income splitting strategies available once you turn 65 for income splitting with your spouse. Unfortunately, if your children aren't actively involved in the business, TFSA means that you can only probably do income splitting through the use of salary, which is subject to a reasonableness test. Of course, leveraging the small business deduction, which means that if you have income inside your corporation, it's only going to pay tax here in Ontario at only 12.2%, as opposed to that highest personal tax bracket that we saw on the previous slide that can go up to 53.5%. We can also use things like tax-free loans, home loans, auto loans, individual shareholder loans, to minimize the amount of income that you've got to take into your corporation. So let's say, for example, that you took out $250,000 to put as a down payment on a primary residence. Well, there are tools that we can use to call that a loan from the corporation instead of having to call that income, and you pay the personal tax rate on that. So again, we have entire webinars dedicated to a lot of these strategies. If you haven't seen it before, I encourage everyone to go check out our top 10 tax strategies to minimize tax. And that covers a lot of these strategies, which I'm just covering at a cursory glance. Now, salary versus dividend, what is the difference between the two? So the salary won't be subject to tax on split income, which is an important differentiator. It is subject to a reasonableness test. So the salary pay must be reasonable for the work involved. So for spouses and financial partners, typically we can do about $30,000 to $35,000. For children, maybe $10,000 to $15,000, depending upon their involvement in the business. Now, the salary is going to be eligible for CPP and eligible for RSP. What we mean by that is that if you pay a salary out to yourself or to a family member, you will have to pay both the employer and the employee portion of CPP. But the CPP is not a tax, it's actually a pension. So that means the more money that you contribute into the CPP, the more money that you'll get out of it in retirement. And we personally believe CPP to be a positive thing. I know it's not necessarily the greatest investment that you will probably make in your entire career, but it does guarantee some form of return in retirement, no matter what happens to the market. It's also eligible for RRSPs, which we'll be talking about more today with the deadline looming tomorrow. So your RRSP room is a function of the amount of salary that you have. You get 18% up to the annual maximum of your salary. So if you do pay dividends, it's not going to be eligible for either CPP or building up your RRSP room. However, it can be better cash flow for you and potentially greater flexibility. So what do I mean by better cash flow? Well, if you're not paying into CPP, you don't have that cash outlay today. You're not going to get it in retirement, but you're not paying it out today, which does help from a cash flow perspective. In addition, the way dividends work is because there is no employer relationship, there's no obligation for any tax withholdings by the corporation that need to be remitted. And again, we have an entire webinar dedicated to payroll contributions and what the different deadlines are for that. But suffice it to say, if you're paying salary, you're going to have to pay the taxes on that salary sooner than when the shareholders are going to have to pay the tax on the dividends, which is due when the shareholder files their personal tax returns and reports the dividends. Now, the corporation does still have a requirement for reporting the dividends that were distributed. That's done with a T5, just like the salaries are reported with a T4. But the shareholder doesn't pay tax until they file their tax return in April. Whereas with the salary, the employer has a responsibility to withhold payroll contributions, remit them to the government, and those are due much sooner than they would be with dividends. So those are important differentiators because they can determine, again, what your average, what your total salary is going to be, and that then ties into income splitting. So if we are doing income splitting, how can we leverage this to reduce the total overall taxes? And this is the reason I wanted to bring this up before we talk about any of these things like RDSPs, RRSPs, TFSAs, those types of investment tools, is because we do have an obligation within the corporation that whatever you physically withdrawn, for the most part, that's going to become taxable income, either in the form of a dividend or a salary. So if you are wanting to contribute to any of these investments outside your corporation, these are potentially going to be taxable income. With an RRSP, they might be offset by the RRSP contribution, but it's first going to become taxable income to you. So we want to first look at how we can minimize that as much as possible so that we can avoid those higher tax brackets and keep your taxable income as low as possible. Because as we said earlier, the corporate tax rate is only 12.2%, whereas the personal tax rate can go as high as 53.5%. So as we said earlier, you do have to be aware of tax on split income when we talk about splitting income. And so this is, you've probably heard some terms around income sprinkling and stuff like that. So that's where TFSA really tried to target the use of, as they called it, income sprinkling or income splitting among family members. It was really targeted at the middle class, despite what Trudeau tried to sell and tell everyone. It was not a target at the wealthy, it was a target at the middle class, because our clients were the ones using this strategy who ultimately were no longer able to give their children dividends while they were attending university at their high spending years. That was a great time when they had other deductions or they could take income. And with dividends prior to the TFSA rules, there was no requirement for them to be actively involved in the business as long as they were shareholders of it. Now with these TFSA rules, we can still do income splitting, but we need to look at strategies around salary, which, as we said earlier, would be subject to CPP and RRSP, which aren't necessarily bad things, but they are also going to be subject to a reasonableness test. So it means you can't go give your kid a $100,000 salary for them mopping the floors in your office. We have to have a salary that's reasonable for their contribution. But I do want to give you one example of what income splitting would look like when we compare one person earning $100,000 versus two people earning $50,000. I'm not saying that this is what your income splitting should be, but in this one particular situation, we've got a tax savings of over $4,442 by splitting that equally amongst two people. And that is largely because we get two basic exemptions, we get two low tax brackets, and we're avoiding the one individual paying tax at the higher tax brackets. In addition to this, even though there's a $4,442 savings, we've actually doubled our CPP contribution because we've made more, well, not quite double. It was a 7,000 versus, what would that be, 5,300. So it's a substantial increase in the amount of CPP that you're going to get in retirement, despite you paying a total of $4,442 lower. You're actually increasing the amount of, sorry, did I say 5,200. I guess it's 10,400 versus 7,000. So another $3,000 in benefit in CPP. So there are some substantial benefits to income splitting. So now the question becomes, okay, we've covered some of the basics of tax planning. We've looked at what the options are, salary versus dividend. We've looked at the options of income splitting. So now we've got some money left over. Where should we actually save that? And what's the best tool for that? And I know you guys want me to give you a straight answer of like, hey, here's the absolute number one tool, but it really is going to vary. So first I'm going to talk about some of the ones that I think if you've got the ability to do them, they're a no-brainer. So first and foremost is an RESP. So if you have children, registered education savings plan is a really great tool. Now, anything you contribute to the RESP is not going to reduce your taxable income the way it might with an RRSP. But what it is eligible for is a grant. And there's a maximum grant of $7,200, which is based on the actual contributions, typically a maximum of $500 based on a contribution of $2,500 each year. So you can do this from the minute your child is born, the year your child is born. You can make a $2,500 contribution, and the government will give you $500 to put into the, that goes right into the RESP, then can be invested and grow. And the beauty of the RESP is as well, it comes out to the beneficiary, which is your children, and is taxable to them when they use it, which is in their education years, which are usually very expensive years for the parents. And it is very tax effective because it's not going to be taxable to you, even though you've made the contribution. It's going to be taxable to your children, and it's going to be taxed to your children at a very effective time. Plus, you're getting up to $7,200 in grant money from the government. So if you have children, this is a no-brainer, and you should be maxing out your RESP contribution every single year, first and foremost, from my opinion. Secondly is the RDSP. So the RDSP is a registered disability savings plan. It is only available to those people who are disabled or have disabled people that they are taking care of. Works very similar to the RESP in that it's not going to reduce your taxable income, but it is eligible for a grant. This grant is between $1,000 to $3,500 with a maximum of $70,000. So it's a much bigger grant than the RESP. You must have a approved disability tax, or you must have a approved disability tax credit on your personal tax return and have completed the Canada the disability form by your doctor in order to be eligible for it. Now, what's interesting to me is that there are a lot more disabilities that people don't realize are eligible. Things like IBS, Crohn's. There are a whole bunch of disabilities that you may not think of that you might actually be entitled to. So you might want to speak with your family doctor to see if you'd be eligible for completing the disability tax credit based on your personal situation. But if you or any of your family members are eligible for the disability tax credit, then taking advantage of the RDSP is another no-brainer and should be done if you've got the ability to do so. After these two, we come into the programs that are a little bit more subjective. So the RRSP, I think most people are familiar with the RRSP, which is the Registered Retirement Savings Plan. It does reduce your taxable income. It's one of two products that will reduce your taxable income. The other one is brand new this year, and we're going to be talking about that. That's the first-time home buyer savings account. Now, the one thing about an RRSP is it can be a tax savings, but it by default is not necessarily a tax savings. It is a tax deferral. You reduce your taxable income today, but you pay tax when you withdraw it, usually in retirement, when you're forced into a RIF in your 70s. Now, the amount of money that you can contribute to an RRSP is based off of your salary, as we've said, and it's a cumulative balance, as many of you are aware. So if you have not been contributing, you might be sitting in a whole bunch of room, but should you contribute? So the first question is usually around what's the benefit you're going to get? And what I tell people is, since it's a tax deferral, if you're earning income at the highest tax brackets, then contributing to your RRSP is a no-brainer. So if you're a full-time employee in a high income tax bracket, RRSPs are your absolute best friend, and absolutely you should be taking full advantage of them because you're going to be saving money at 53.5%, and then hopefully in retirement, maybe you're pulling it out of a lower tax bracket, maybe in the 20% range if you're in the lowest tax bracket. However, if you contribute at the lowest tax bracket, but then you build up a whole bunch of money in your RRSPs, and when you're forced into a RIF, you actually have higher income, you can actually increase your tax obligation. Instead of bringing it from a high tax bracket down to a low tax bracket, you could actually take it from a low tax bracket to a high tax bracket. And because most of our clients were able to control what their salary is by not taking money out of their corporation, we are not in those high tax brackets, and we often say, hey, an RRSP might be better saved for a time where you may go back for a full-time role, whether it's to get certain experience or to take a specific role, because it's not uncommon for people to move in and out of full-time and contract work, full-time and contract work. So for many of our clients, the RRSP is not necessarily the best tool for that reason. The other reason that it's not sometimes the best tool is understanding how the investment income inside an RRSP is taxed versus investment income in other unregistered tools like your corporation or an unregistered investment held personally. So with an RRSP, there's no such thing as a capital gain or interest income or dividend income from a tax perspective. You're just taxed on whatever you take out. So whether you're investment income, capital gains, dividends, it doesn't really matter from the RRSP's perspective, which makes it good from a tracking perspective. It makes it really simple. You don't have to do any reporting whatsoever. It's just all handled by when you withdraw money out of the RRSP. But that's actually potentially a negative. And that's because a capital gain is actually only taxed at 50% of the gain. So if you have a capital gain, let's say you buy a stock for $100,000 and you're able to sell it for $200,000, that's a $100,000 capital gain. So inside an RRSP, if you took out that full 200, you're going to be taxed on the full 200, including the $100,000 gain. Whereas if it was held inside of a corporation or in an unregistered investment, you're actually only taxed on half the gain, so you'd only be taxed on $50,000, not effectively the $100,000. So that is an important differentiator where an RRSP may not share all the same benefits as some of the other tools. But if you are an employee in the highest tax bracket, it is a no-brainer. Make sure you're maxing out your RRSP contributions each and every year. And again, go back to those tax brackets that we talked about earlier. Now, if you're an employee, the only other thing that might potentially be better than an RRSP is the first-time home savings account, which is brand new this year. And you'll be able to contribute up to $40,000 over the lifetime, and that's at $8,000 per year starting in 2023. So you can start contributing this year, but the rules don't actually take effect until April 1st. If you don't contribute, you can carry forward up to $8,000 of your unused annual contribution room. But it is important if you are planning to buy a home and you're still haven't bought your first home, that you start contributing in 2023 because you can only carry forward that $8,000 of your unused room. Now, a first-time home savings plan sort of blends the benefits of a tax-free savings account and an RRSP tool. We haven't talked about the tax-free savings account here yet, but many of you are probably familiar with it. And so, like an RRSP, it's going to reduce your taxable income. So if you make an $8,000 contribution, it's going to reduce your taxable income by $8,000. Unlike a RRSP, you're not going to be taxed when you take the money out of your first-time home savings account. That's similar to a tax-free savings account, which has already been taxed and is tax-free. So this blends the benefits of both. So this is the absolute best tool for you if you are planning to purchase a home. Now, with an RRSP, there's still the home buyer's plan. You can actually do the home buyer's plan in combination with the first-time home savings account, which is important because, quite frankly, even the two of these combined probably still aren't enough for the down payment that's required, even in the market that is contracting right now as far as real estate. Prices are still pretty scary when it comes to first-time home buyers, and the down payments can be quite significant. The other thing is the tax-free savings account. Again, this has been around for a little bit now, so people are a little bit familiar with the tax-free savings account. Now, the tax-free savings account isn't going to reduce your taxable income. However, the benefit of the tax-free savings account is that any income that you earn in this, whether that's capital gain, whether that's RRSP, whether that's dividend, is going to be completely tax-free. And in addition, if you take money out of your RRSP, wait a year and put it back, or sorry, out of your tax-free savings account, wait a year and put the money back in, you'll get back the room that you took. You'll get back the room for anything that you took out if you wait that 1 year. With an RRSP, if you take money out, you don't get that room back no matter how long you wait. Your contribution room will always be tied to your salary, whereas the tax-free savings account is tied to the annual the annual contribution amounts that you're allowed, which for 2022, if you haven't contributed yet, and you were 18 or older in 2009, is right now up to $81,000, $500. We used to have a schedule in this, which I accidentally deleted, which shows the amount of room that you had per each year. But again, you can check this just like you can check your RRSP availability on your CRA portal. So if you go to my CRA site, you can log in to see how much RRSP contribution room you have, as well as how much TFSA contribution room that you have. And I'm sure they will also be making that available for the first-time home savings account after April 1st, once it actually becomes a tool that's actually available to do. So TFSA is a great tool for an emergency reserve because it's got that ability to be able to take it out for, let's say you got to do a new roof on your house, or your kids are getting married, or whatever the case might be. You can pull the money out, and if you wait a year, you'll get that contribution room back, and you can put it back in later. So that's a great tool from that perspective. And again, because it is growing tax-free, it is a really effective tool. The only downside is that it doesn't reduce your taxable income, which means if you are a business owner and you've got to pull that money out of your corporation, you're going to have to first pay personal tax on it. And again, going back to what we talked about earlier at the beginning of the slide, those marginal tax brackets, taking money out at the highest tax bracket to contribute to a TFSA is not necessarily the best strategy. But what a lot of people have, if you haven't maxed out your RSP room or your tax-free savings account room, a lot of people are still sitting on a large amount of equity in their real estate. Even with interest rates rising, there's typically a benefit to potentially taking money out of a line of credit on your home and putting it into a tax-free savings account, so long as you can invest that and generate a higher rate of return than your cost of borrowing. So that's an effective tool to maximize that if you haven't and you're a small business owner. Now, if you are a small business owner and you have money left over inside your corporation, investing inside the corporation can be a really effective tool. So the benefit here is that you don't have to take this money into personal income, and you can avoid those personal tax brackets, those higher personal tax brackets we've talked about earlier. And because here in Ontario, your small business tax rate is only 12.2%, that means that you're effectively investing $88. Now, the RRSP is great because you're investing $1. So $1 versus 88 versus, if you're investing in a TFSA or an unregistered, you might be contributing as little as 44 cents on the dollar. And what I mean by that is if you're paying tax at the 55% or 53.53% tax rate, then and you earn $100 at that tax rate, you actually only have $46 left to actually invest after the taxes. Whereas in the corporation, you'd have 88 cents to invest, or $88 to invest. And with an RRSP, you'd have the full $100. But what the corporation is going to bring with it is the fact that you're actually only going to be taxed on 50% of the capital gain. So you have a little less to invest right now, but you're going to be taxed substantially more favorably in retirement or when you realize the gain. And when it comes to capital gains, you are only taxed when you actually realize the gain. So let's say that you invest, $100 into or $100,000 into a stock, and it grows and it's now worth $200,000. Well, if you haven't sold the stock, you don't actually have to pay the capital gain. You only pay the capital gain when you actually sell the stock and you realize the gain. So a corporation can be a really effective tool, and it's often where we recommend people start to invest rather than an RRSP when you are an owner-managed business. So those RESPs and RDSPs, those are sort of no-brainers. Start there unless you're in the absolute highest personal tax bracket already because of your lifestyle. But then probably inside your corporation is the next best place. And if you build up a large amount of money inside your corporation, that can be used as a retirement vehicle. And so when we talk about our mission to help our clients organize their finances, create wealth, and transform wealth into a legacy, often we're talking about doing that with a corporation, because a corporation is a vehicle that can survive you as an individual, whereas an RSP is not. When you pass, that money will flow to your spouse tax free, but if you're the last to die, it is going to be taxed at your estate at potentially high tax brackets. Whereas a corporation can survive you and continue on and be transitioned to your children or whatever is an important cause to you, and it can continue on beyond your life. And that's another advantage of investing inside your corporation from an estate planning perspective. And that's why we really love corporations for their small business tax rate and their ability to survive you and become a legacy that you're passing on to future generations. Now, lastly, I do want to talk a little bit about unregistered investments. In some situations, these make sense, but these are usually the least favorable option. And that's because obviously they're not going to reduce, well, maybe not obviously, but they are not going to reduce your taxable income. So you're going to be subject to whatever your personal income tax rate is on the income that you want to invest, unless you're taking it from some form of debt. And the one place I would say that unregistered investments make sense is with something called a Smith maneuver. If you're not familiar with it, it's where you take debt against your real estate, your primary real estate investment, and you invest it in an unregistered stocks. And the debt or the interest on that debt can be deductible against the income you earn in your unregistered investments. So sometimes a Smith maneuver, an unregistered investment might make sense. Or if, let's say, that you had inherited a large windfall that you had no control over the tax, or again, maybe you're a very high income earner, you've maxed out your RSP, you've maxed out your TFSA, then an unregistered investment might make a logical tool for you. And that's really the last of the tools that we're going to talk about today. I've been talking a mile a minute. I'm a little parched here. I wish I brought some water with me. I do want to open it up for Q&A. I don't think I've seen any questions come through yet, but I'll take this time to open it up for any questions that we have. I think some of you have already made contributions to your RSPs. For those of you who haven't, you do still have a bit of time if you are considering it. We've got our first question here, which says, can I use the money in my business account to purchase a second property? Great question. So your corporation can hold a variety of different types of investment, including real estate investment. So yes, you could use the money inside your corporation to purchase an investment property. Now, the one thing that you want to be careful of is that it's not a personal residence, and that if you are using it all, that you are making sure that you are paying for your use of it, because if it's ever deemed to be a personal residence, there could be some implications there. But the other thing to be aware of is that it is an investment property. You might want to consider setting up a holding company. The reason people set up holding companies for real estate investments is because real estate investments can bear some risk. You can imagine if someone were in if the house were to burn down, there could be some liability there, and you wouldn't want to put your other assets at risk. So separating a separate holding company to segregate the liability of that real estate investment might be beneficial. Of course, there are some additional costs, so you got to weigh the cost benefit of that. But a corporation can most certainly hold investments in real estate. One of the other things to be aware of when you're comparing a corporation to, say, an RRSP, is there are some more tools that can be done, like leverage. You can't use leverage in an RRSP, which means what leverage is is it allows you to use the investments that you've got to effectively borrow against, so that the bank will lend you more money so that you can invest even more money. Now, leverage can be a really useful tool, but can also be a very dangerous tool. So you shouldn't be doing that without speaking with a financial advisor, but it is an additional option that is available for you, as well as things like puts and calls. So you have way more options available to you as far as what you can invest in inside your corporation than you would have in a registered investment like a TFSA, RRSP, or a first-time home savings account. So I hope that answers your question. And awesome. I think, oh, we got one more. Can a grandparent start an RESP contribution for a new grandchild? Um, so, I mean, yeah, it doesn't matter where the money comes from as far as the contribution. The eligibility for the grant is tied to the child. So it doesn't double the room or anything like that. But if the grandparent wanted to make the contribution into the RESP, that could be done. And in fact, that's often what we do is with our family, we, say, hey, if you're going to do anything, we'd love a contribution to the kids' RESP. And I know my stepbrother loves to do that and make sure that he's contributing to the children's education. So they usually give it to us and then we make the donation. But effectively, I don't think it would matter whether the grandparents made the direct contribution. Um, can we have a copy of your slides? Yeah, I think they're actually already available in SlideShare through LinkedIn. If not, I will make sure that we upload those so that they are available. But I think they're actually already there. Given the highest tax rate on passive income, what is the advantage of investing through your corporation after you've retired and have little active income? So actually, a really interesting point here is, and I sort of glossed over it a little bit, I didn't even really cover it today, is that investment income is not eligible for that 12.2% tax rate we talked about earlier. That 12.2% is the small business tax rate. So it's only on eligible small business income. Passive income is not eligible small business income, and it does pay a higher rate. And in addition, investment income, whether it's dividend income, capital gains, or interest income, are all taxed differently. And the benefit of investing inside your corporation when you were, no longer active inside your corporation is because you still, let's say that you build up a large amount of money inside your corporate, and the goal of which, by the way, the goal is to build up a nest egg inside your corporation that is sufficient for you to live off the interest alone. So if you needed $100,000 a year and you had 10% rate of return, you'd need $1 million worth of investable assets. If you had $1 million worth of investable assets inside your corporation, it would generate $100,000 a year of income. You could pull that $100,000 out without ever having to touch your principal, and you'd be able to do that in perpetuity. That's the simple version of it. But the advantage of having that inside your corporation is that one is going to live on as a legacy for you. Number two, it's going to give you full control over what your taxable income is, both while you're alive and once you pass. With an RRSP, once you hit 71, the amount that you have to pull out of your RRSP and your RIF is set. There's a minimum amount that you must pull out. You don't have control over that. Whereas the corporation, you would have more control over that. So let's say, for example, you only needed $35,000 out of your corporation. You could take only $35,000. Whereas, if you had, I don't know, several $1 million worth of investments in your RSPs, and you had a RIF that was more than 35, you'd have to take out, 5% of whatever the portfolio is as you wind that down. And in addition, while the income is taxed at a higher rate, you are, like I said, you've got first of all, the fact that you have invested 88 cents on the dollar, so it's going to grow and compound faster. Whereas if you'd taken it out, If you can take it out less than 12.2%, hey, it's a no-brainer. But usually you're going to have to take it out at a higher tax rate and you're going to have less to invest. Now, as far as an unregistered investment versus a corporate investment, as far as what the effective tax is going to be on dividend income and interest income and capital gains, that's going to be fairly similar. So if you can get the money out at close to 12.2% and you've got the same amount of money to do it, great. But that's usually not going to be the case. You're going to pay a lot more to take it out personally and invest it. So if that makes sense. Hope that answered your question. In terms of leverage, what is the advantage of getting tax prepared certified versus not? To be honest, I don't really understand your question. Maybe you can rephrase that. So yeah, and I don't really know the answer, unfortunately. Um, I would like to use my money immediately to buy a house, and I haven't contributed to a tax-free savings account or an RSP. Since my money needs to be in RSP for at least 3 months, my only choice is to invest in a TFSA. I may purchase a house in 1 or 10 months, depending upon the market and the availability. What type of TFSA? So I don't make recommendations on what type of stocks. I'm not a financial advisor. I can't tell you what stocks or mutual funds to buy. What I can tell you is I don't generally like mutual funds because of the way the fees are structured. I prefer stocks. I'm working with a fee-for-service financial advisor who's going to charge you a wrap fee based on the percentage that you invest. So you know, and a TFSA is a TFSA is a TFSA, whether you're investing in stocks or mutual funds, that's sort of up to your financial advisor. And unfortunately, yes, for the home buyers plan, the money does have to be there in there for a certain amount of time. If you can take advantage of that at all, if you can defer your buying opportunity, and you know, just an aside, and this is just, you know, personal opinion, so take it for what it is. I think the real estate market has not bottomed out yet, and I think you're looking another minimum 3 to 6 months before it does. So if you're thinking of buying a house, I'd be holding off for another 3 to 6 months anyways. So I would certainly consider putting that money into your RRSP and waiting a little bit more time for a bit more of the bottom of the market, because I don't think interest rates are done going up, and I don't think we've hit the bottom of the market in real estate. But that is personal opinion, nothing more. We've got some more questions from social media. Does CPA for IT provide a service to help navigate you through all those tools and build a customized plan according to my situation? That's a little bit more of a financial advisor. We do have a financial advisor that we can recommend who could help you build a structured portfolio with percentages and those types of things. Certainly here to help you and understand what the different tax implications are. And we do tax planning with you at your year end to look at strategies as far as, hey, we might look at a high level as far as whether you should consider contributing to an RSP, you know, and what impacts that will be. But balancing those out and how much to invest and what types of stocks is where you want a financial advisor. And like we said, we have people we can recommend, but we ourselves are not financial advisors. What are the rules, cost implications of early withdrawal from an RSP outside the options? So basically, it's real simple. You're going to be taxed at whatever your marginal tax rate is. There will be a withholding. It's usually about 30% by your financial institution, because the amount of tax you pay is going to be dependent on your personal income. So if you have other income, this is going to be taxed on top of that other income. If it's the only income that you have, you know, it's just going to be taxed at whatever your marginal tax rate is based on how much you withdraw. So if you have investment properties and you're passing it on to your children, so they're taxable capital gains from, you know, the difference between what you bought it at and what its value is at death, and the estate will pay taxes at the estate's marginal rate at that time. If you held it within a corporation, then the corporation doesn't have a deemed disposition. It's not going to be sold, and there would still be potentially some tax implications on the valuation of the corporation, but the corporation can continue on. And there are things that can be done with estate freezes and rollovers and stuff like that. But the corporation, if it's invested inside a corporation, the property wouldn't have to be sold, or there wouldn't be a deemed disposition. Whereas if it's held personally, there would be a deemed disposition. So even if the property isn't sold, the estate will pay a tax on the difference in value between what you bought it at and what its value is at that date. What are your services and price ranges for corporations? So all our pricing is available on our website. So if you go to our website and search pricing, we have different packages available. The I think they start at about $225 a month and go up from there, depending upon the amount of work that you need, the amount of involvement you need from us. And we're available to work on a time and material basis. So the more help that you need from us, the higher the fees. The more that you can do for yourself and the more organized you are, the lower your fees will be. So I know it's a bit of a generic question, but again, I encourage you, come book a free initial consultation with my colleagues, Karen or Rachel. We'd be happy to look at your personal situation and give you a structured plan that would work for you. And I think that's the end of our questions. So thank you everyone for joining me today. We will be back next month with another webinar, and I wish you the best of luck as you are organizing your finances, creating wealth, and transforming wealth into a legacy. Bye for now.